Thanks for joining David, Kevin, and myself for the market update for the month of July. Hope you and your families are doing well. July was as well a fantastic month. Everything kept moving forward, which is nice for all of us. The S&P 500 was slightly up. It was the weaker link this time. It was up 0.86%. And a lot of that was some of the big tech stocks took a breather, like NVIDIA. They just sort of took a little bit of a step back. The Canadian market, the S&P TSX, was up 5.65%, so it was really strong. A lot of that was on the back of a couple of interest rate decreases in Canada. And the developed European and Asian markets, the EFI index, was up 2.38%. So all in all, everything was very, very positive for the month of July. I'm going to pass it over to the guys, and they're going to do a little bit more of a deeper dive into that market. But as always, don't forget, if you have any questions, please don't hesitate to give us a call. Take care. Off to you guys.
So what exactly was happening in the U.S. markets in July, Kevin?
Well, preliminary estimates suggest that U.S. GDP expanded by 2.8% annualized over the second quarter of 2024, and this was up from the 2% estimate that many economists had forecasted. Now, amid the backdrop of moderating inflation, which the U.S. appears to have well under control, and continued positive growth in GDP, the U.S. Federal Reserve did announce on July 31st that they were content to hold interest rates at the 5.25% to 5.5% range, which is where they've been for the past 12 months. Now, U.S. Fed Chair Jerome Powell did concede that, given the economic data, that they would consider a rate cut at their next meeting in September. Now, in light of this announcement to hold interest rates where they are, the U.S. stock market, as measured by the S&P 500, was still positive 1.6% on the day. Now, what this tells us is that the continued strength of the U.S. economy shows that the Fed's on track to hit the soft landing that they'd been aiming for and avoid a recession that many prognosticators had been forecasting since early 2022. What was going on in the Canadian stock market, David?
Well, in a widely expected move, the Bank of Canada once again cut interest rates by 25 basis points in July. So the interest rate in Canada now is at 4.5%. And similar to the United States, we're seeing moderating inflation. In fact, inflation numbers are probably even a little cooler in Canada than the US, due to the fact that our economy isn't running quite as hot as the US. We're starting to see some pockets of minor concern, I guess, with slowdowns, especially in real estate market. The condo market in Toronto, for instance, is really hurting new sales in condos in large urban centers, primarily Toronto. Due to high interest rates, of course. So there is some concern with activity there for Canada's economy. So now the Bank of Canada is pretty confident that they're going to see inflation get down to 2% in 2025. And so we're clearly on the path to more rate cuts in Canada. We'll probably get at least one more here in 2024, with more cuts likely in 2025. And now the Bank of Canada is probably actually a little bit more focused on maintaining or propping up the pockets of the economy that might be faltering with these interest rate cuts, because they're pretty confident that inflation is well under control. And that's part of the reason why the Canadian stock market performed so well in July, is that when interest rates get cut, asset prices, i.e. stock prices, real estate prices, tend to go up. So that's what was driving the performance in July for Canada's stock market.
Overall, 2024 has been smooth sailing for investors. Inflation continues to moderate, interest rates are poised to drop, and economic growth has been okay thus far, despite 2 years of tight financial conditions. Now, volatility in the stock market has been extremely subdued in 2024. In fact, we only saw one single day, which was July 24th, that saw the S&P 500 drop or trade down by more than 2% on the day. Amid this low volatility, the S&P 500 has steadily notched 37 new record highs so far in 2024. Now, if we look back, the S&P 500 has eclipsed a 15% return in the first half of a calendar year 28 times previously. In 21 of those years, or 75% of the time, it continued to show positive growth through the latter half of the year. in only 7 of those years, or 25% of the time, did it give back gains with negative results in the second half of the calendar year. So I would say history is on our side, that we should continue to see further positive growth in the second half of 2024.
While it's undoubtedly nice to bask in the warmth of the recent equity markets that we've had in summer 2024, it's a good time to remind ourselves to not be lulled into a false sense of security, given the positive performance we've seen over the past 9 months. It's not always going to be this subdued and this easy in the investment markets. Things are setting up still pretty well for the second half of the year, but things, as we know, can come out of left field. You know, we can have things emerge that today we aren't even on their radar. You know, many people are obviously have some concerns over a U.S. presidential election later this year. Our group is not particularly concerned. History shows that there's not a lot of difference in equity market performance between Democratic presidents or Republican presidents, or who holds the House and Congress. Obviously, the policies of different administrations can have effects on certain segments of the economy, but that's not something that we're overly too concerned about at all, to be honest. Things are setting up nice for the second half, but just it's a good reminder to recognize that there will always be ups and downs, and as Warren Buffett has said many times before, it's time in the market, not timing the market, that makes for a successful investor. So just a reminder that while things have been good for the last 9 to 12 months, I'm sure that at some point in time volatility will reemerge for whatever reason. Nobody knows what the catalyst will be or when it will happen, and that's the difficult thing with investing, is just recognizing that none of us have these answers. But if we arm ourselves with the right asset allocation, i.e. mix between stocks and bonds, the mix between risk versus reward, as well as your individual risk tolerance, your capacity to take on risk, and the time horizon for your investments, if we build the right portfolio for you, you should be able to navigate through the downs of the markets to ultimately be rewarded with the ups, which is what we've been fortunate enough to go through for the past 9 to 12 months or so. So just a good reminder to everyone out there to always remain patient with your investing, and as always, if you have any questions, don't hesitate to reach out to Kevin, Harry, or myself.
Take care.